Stop. If you are chasing the Nikkei 225 right now, at these highs, you are walking directly into the one trap that institutional desks are setting this very minute. This is not a normal rally. This is a critical structural test against a 34-year ghost, and there is an inflation data release coming that will act as the trigger. There is one danger zone, a mere 800 points from here, and one hidden opportunity on a pullback that nobody is talking about. I'll show you both. And stay until the end, because I'm giving you the 3 exact entry levels, stop losses, and targets you need to trade this. Whether we spike or whether we collapsed, I'm looking at the Nikkei 225, current price 63,339. And I am declaring the session bias as trend continuation, but with a severe, imminent trapdoor. We are grinding higher. The moving averages are perfectly aligned for a strong buy, but we are entering a structural resistance zone that invites a violent shakeout before any real breakout. This is not a range-bound market. This is a trending market squeezing the last outers out. The invalidation level that proves my cautious bullish bias wrong is not a number above us. It's a number below us. Write this number down. If we break and close on the 4-hour chart below 60,972, the whole bullish structure shifts. That's the line in the sand that separates a healthy pullback from a systemic failure. Comment that number. 60972. I want to see it in the comments so I know you're paying attention. That's your risk anchor for the day. Let's pull up the weekly chart. This is where you have to step back from the noise. The Nikkei is completing a multi-decade cup and handle pattern. We are finally, officially, above the 1989 bubble peak. That's the context. The weekly trend is a strong buy. The MA20 on the weekly is sitting way down at 56,000, acting like a rising tide. The MA200 on the weekly is at 52,830. That's the bedrock. This isn't a market trying to find a top. This is a market in a structural bull run. The MACD on the weekly is making higher highs. No negative divergence. Buyers are not exhausted on the long-term view. They are accumulating, but here's what most traders miss. Dropping down to the daily chart, price is running hot, very hot above the MA20 at 61,136. The distance between price and the daily MA50 at 59,196 is widening. This is a momentum spike. The RSI is at 62, not yet overbought, which is why we aren't calling for a reversal, but the compression is happening. The MA10 is at 61,720, and the MA5 is at 62,067. This short-term moving average cluster is our dynamic support. A pullback to that 62,000 zone would be a healthy refuel for the next leg. Right now, my key daily support is 60,972, and my key daily resistance is the zone around 63,772, which we are currently testing. A break above that opens a vacuum straight to 65,166. That is the next major structural resistance, a Fibonacci extension level that aligns with the top of the rising channel. Now, let's weave in the real driver. I call this the intervention ghost narrative for the Nikkei. You cannot, I repeat, cannot trade the Nikkei 225 today without having the US dollar to Japanese yen chart on your second screen. The cross-asset link here is absolute. A rising Nikkei historically relies on a weak yen. It's the carry trade. But we have a fracture in that logic right now. The 24-hour news is laser-focused on the upcoming Japanese inflation data. The CPI print is not just a statistic. It's a battle plan for the Bank of Japan. If inflation runs hot, it accelerates the timeline for a BOJ rate hike. A rate hike strengthens the yen. A stronger yen crushes exporter margins and mechanically forces the Nikkei lower. You are witnessing a tug-of-war where the Nikkei is trying to break higher on global tech sentiment, while the yen is sitting like a loaded spring, ready to destroy that momentum if the BOJ moves from ultra-dove to hawkish. Look at the 4-hour chart on the US dollar to Japanese yen. It's stalling. The MA20 is flattening. If the dollar-yen pair breaks down below 155, you will see an instantaneous, algorithmic sell-off in the Nikkei. The risk sentiment validation is simple. As long as US dollar to Japanese yen holds its ground, the Nikkei's path to 65,000 is clear. The moment the yen spikes on intervention fear or data, the Nikkei's bullish thesis is on life support. My 1 to 2 week directional lean is cautiously bullish, targeting that 65,166 level, but I will flip bearish instantly and without hesitation if US dollar to Japanese yen drops 200 pips in a single session. That's the invalidation for the macro thesis. Most people will skip this part, but this is where money is actually made. Keep watching. I'm giving you 3 actionable plans for 3 different types of traders. Strategy 1, the sniper, conservative. This is the one you wait for. You don't chase. You wait for the trap to trigger. Your exact trigger condition is a move up to the 65,166 resistance zone, followed by a sharp 60-minute rejection candle, a long upper wick, what we call a shooting star, closing back below 64,800. That's the bull trap. You sell short on the close of that candle. Your stop loss goes 1 point above the wick's high, logically placed above the liquidity grab. Your target 1 is 63,000, a round number and support. Your target 2 is 62,000, right at that MA5 cluster I mentioned. This gives you a risk-reward ratio of roughly 1 to 3. The setup is voided if we consolidate just below 65,166 without a sharp rejection, as that signals absorption, not exhaustion. Strategy 2, the active trader, standard. This is a buy the pullback strategy, aligning with the daily trend. Your entry condition is a mean reversion pullback. We wait for a 4-hour candle to dip and touch the MA20 at 61,136. You don't just hit the market. You wait for a bullish MACD crossover signal on the 60-minute chart at that level. That's your confirmation. Your stop loss goes right at 60,800, just below the daily support and the round number, giving the trade breathing room. Your target 1 is 63,700, near the current highs. Once target 1 is hit, you move your stop to break even. Your target 2 is 65,100. This is your swing trade. Simple, clean, structured. Now, interaction moment. Let's see how aligned the community is. Type your Nikkei 225 range for the next 24 hours in the comments right now. Give me a high and a low. I'm reading through these every day, and the most accurate traders get a shout out in the next video. I want to see if you're thinking 62 to 65, or if you think we crack 60. Strategy 3, the aggressor, high risk. This is the scalp for the inflation data release. Only for those who know how to lose small and manage risk aggressively. We anticipate a positive, market-moving reaction to the data. On a strong, high-volume 15-minute candle that closes above 63,772 with no upper wick, you enter long on the next candle open. This is a momentum chase. Your stop is devastatingly tight, placed at 63,300, right below the pre-breakout consolidation. Your target 1 is 64,500. That's it. A quick, explosive scalp. If the price retraces even slightly after the break, you're out. This is not a trade for the faint of heart. It's a statistical gamble on momentum continuing from a confirmed breakout point. But the trap risk is highest here. You have been warned. A critical anchor for all these longs. Watch the VIX of Japan, the Nikkei Volatility Index. If the VIX spikes above 25 while the Nikkei rises, distribution is happening. The smart money is selling into your buy order. That's your hidden signal. Let's be perfectly clear. Never risk more than 1 to 2% of your total account on any single Nikkei trade. The yen-driven gaps on this index are legendary. No positions held through the actual BOJ announcement or the CPI release if you are a swing trader. Stops are non-negotiable. A 300-point move against you happens in seconds. Respect the size, respect the speed. Here is your final truth. The entire Nikkei narrative for the next month rests on one number, 60,972. Hold above it. and the path of least resistance is 65,166 and beyond. Lose it, and we are staging a massive, violent correction to the 200-day moving average. Tomorrow's focus is the aftermath of the CPI, specifically the bond market reaction and the JGB yield curve. If yields rip higher, the trap I warned you about springs. If you want the full breakdown on Bitcoin and the S&P 500 divergence and how it's mirroring this exact yen carry trade narrative, that video is live now. Check the end screen, click it, and continue your analysis. You need to see the cross-asset flow. Smash that like button right now if this analysis gave you a clear, executable plan. It tells the algorithm to keep delivering these alerts. Subscribe, hit the bell, and I promise you, you will see these market traps forming before the herd ever knows what hit them. I'll see you in the next one.